Welcome back to Thoughts on Investing. Today, we're diving deep into PayPal, breaking down the business, the bull and bear case, and why this stock could be far more interesting right now than most people realize. Let's start with the basics. What is PayPal? Most people think of PayPal as just a checkout button or a way to send money online. But PayPal is much bigger than that. At its core, PayPal is a global digital payments platform. It allows people and businesses to move money digitally, online, in apps, and increasingly in physical stores. PayPal operates in more than 200 markets, supports multiple currencies, and serves hundreds of millions of active users. That scale alone makes it important. But PayPal isn't just one product. It owns Venmo, which is one of the most widely used peer-to-peer payment apps, especially among younger users. It also offers merchant services, checkout solutions, fraud protection, and payment processing for businesses of all sizes. In simple terms, PayPal sits in the middle of transactions. Whenever money moves from a customer to a merchant, PayPal takes a small cut. And that business model matters because payments are a repeat behavior. People don't just pay once, they pay over and over again. Now here's the key reason PayPal is still important. Digital payments are not a trend anymore, they're infrastructure. E-commerce, subscriptions, marketplaces, freelancers, cross-border payments. All of this depends on fast and trusted digital payment systems. PayPal helped build that system early. It has brand recognition, trust, and long-standing relationships with merchants and platforms. For many businesses, PayPal is not optional, it's expected. That doesn't mean PayPal doesn't face challenges. Competition is intense. Margins have tightened. Growth isn't what it used to be. But importance and excitement are not the same thing. PayPal doesn't need to be the fastest growing fintech to matter. It needs to remain embedded in how money moves online. And right now, it still is. That's why PayPal is an interesting company to analyze, especially after years of underperformance in the stock. Before talking about valuation or the chart, it's important to understand this first. PayPal isn't a broken business. It's a mature payments platform operating in a competitive space. And whether that maturity is a weakness or a hidden strength is what the rest of this video is about. Now that we understand what PayPal actually is, the next question is obvious. Why has the stock struggled so much? And is that a warning sign or an opportunity? Let's start with the bear case, because that's the story the market has been focused on for a while. The biggest concern is competition. Payments is a crowded space. You've got Apple Pay, Google Pay, Block, Stripe, Adyen, and even banks building their own solutions. Merchants now have more choices, and that puts pressure on fees and margins. Another issue is slowing growth. PayPal used to grow very fast. That era is over. User growth has slowed, transaction growth is more modest, and investors no longer see PayPal as an exciting fintech disruptor. There's also the perception problem. PayPal isn't flashy anymore. Venmo isn't growing like it once did. And for years, management made decisions that didn't inspire confidence. So the bear case sounds like this. PayPal is a mature company in a highly competitive market with slower growth and shrinking margins, and that's not a recipe for premium valuation. That's the argument. But now let's talk about the bull case, because this is where things get interesting. The bull case starts with a simple idea. PayPal doesn't need to be exciting to be valuable. It already has scale, brand trust, and hundreds of millions of active users. That's extremely hard to replicate. Even if growth is slower, PayPal still processes an enormous volume of transactions every year, and it earns money on each one. Another key point is profitability. PayPal generates real cash flow. This is not a money-losing fintech experiment. That gives the company flexibility to invest, to cut costs, to buy back shares, and to improve margins over time. The bull case also assumes stabilization, not hypergrowth. If PayPal can simply hold its position, not dominate, not explode, but remain a core payment option for merchants and consumers, the business remains very valuable. And when expectations are low, companies don't need to outperform dramatically to surprise investors. They just need to do better than feared. That's why the bull case matters more right now. The bear case is already well known. It's already reflected in the stock price. The bull case isn't about PayPal becoming the next big thing again. It's about PayPal proving it's still relevant, still profitable, and still embedded in digital payments. In other words, the downside story is priced in. The upside story is still being debated. And that imbalance is what long-term investors pay attention to. So the real question isn't whether PayPal will grow like it did 10 years ago. The real question is much simpler. Can PayPal remain an important piece of digital payment infrastructure? If the answer is yes, the bull case becomes much more compelling than the bear case at today's prices. All right, now let's get into the numbers, because this is where PayPal gets interesting. First, valuation. PayPal is currently priced like a company the market has low expectations for. The stock is trading at roughly 12 times earnings on a trailing basis and around 10 to 11 times earnings on a forward basis. That's not AI hype pricing. That's more like prove it to me pricing. Now let's look at what the business is actually doing. In Q3 2025, PayPal reported net revenue of $8.4 billion, up 7% year over year. Operating income was about $1.5 billion, and operating margin was around 18%. Earnings were solid too. PayPal posted GAAP EPS of $1.30 and non-GAAP EPS of $1.34 for the quarter. And here's the part a lot of people miss. PayPal is still a cash-generating machine. In the same quarter, PayPal reported adjusted free cash flow of about $2.3 billion. That cash flow is a big deal because it gives PayPal options. They can reinvest, cut costs, build new products, and return money to shareholders. On capital returns, PayPal repurchased about $1.5 billion of stock in Q3 alone and has been buying back shares aggressively over time. And importantly, PayPal also announced its first ever dividend, a quarterly dividend of 14 cents per share, targeting a payout of about 10% of underlying profits. Balance sheet next. As of Q3 2025, PayPal reported $14.4 billion in cash, cash equivalents, and investments, and about $11.4 billion of debt. That's not a stressed balance sheet. It's a company with meaningful liquidity and manageable leverage. Now, the pipeline question: what is PayPal actually building that could change the story? One big theme is improving checkout and making PayPal more useful for merchants. PayPal has been pushing Fastlane, a faster guest checkout product, including a partnership with Global Payments to bring PayPal and Venmo checkout to more merchants. Another theme is making Venmo more than just send money to friends. PayPal announced a Venmo Plus Built partnership designed to expand Venmo into rent, mortgage, and everyday commerce-style payments. And then there's the future-looking bet. PayPal is trying to be relevant in a world where shopping and payments become more automated. They announced a partnership with OpenAI to enable PayPal checkout in ChatGPT and support merchant processing for OpenAI's instant checkout concept. Finally, on the crypto/stablecoin side, PayPal has been expanding PYUSD, including an expanded partnership with Coinbase aimed at improving access and use cases for the stablecoin. So when you add it up, the Phase 3 takeaway is simple. PayPal is valued cheaply compared to many large tech names. It's still growing revenue. It's still highly profitable at the operating level. It generates serious cash flow, and it's actively rolling out products and partnerships aimed at keeping PayPal and Venmo relevant in the next version of digital commerce. If the market shifts from PayPal is finished to PayPal is stabilizing, that's where the valuation can re-rate. All right, now let's look at the PayPal chart, starting with the weekly time frame, so we can see the bigger picture. PayPal was in a strong uptrend until around July 2021. After that, the stock formed a double top, and that's where the downtrend began. What followed was a very heavy sell-off. You can clearly see that the volume during the decline was high, which tells us a lot of investors were exiting their positions. For a company of PayPal's size, the drop from mid-2021 over the following year was very large. Since that big decline, something important has changed. Instead of continuing lower, the stock has been moving sideways. This is what accumulation often looks like. Price has been mostly stuck between the low 50s and the low 60s, and it's been doing that for a long time. What I like here is that selling pressure is clearly fading. The heavy selling we saw earlier is no longer present. Volume on down moves is much lower now, which suggests that most sellers are already gone. At the same time, we're seeing signs of a bullish divergence. Price is flat, but selling momentum keeps weakening. That's often what happens when a stock is building a base. So from a technical perspective, this doesn't look like a stock in trouble. It looks like a stock that has already gone through its pain and is now being accumulated quietly. Because of this, I wouldn't expect a straight line higher. It's more likely that PayPal continues to range for a while. But the longer a stock builds a base, the stronger the move tends to be when it finally breaks out. On a longer time horizon, 1, 2, even 3 years, this setup supports the idea of higher prices, especially if revenue and cash flow remain strong. And that's the final point. While the price has been flat, PayPal's free cash flow has remained mostly positive. That's a healthy sign, and it supports what we're seeing on the chart. So overall, at these levels, PayPal looks less like a falling stock and more like a company in a long accumulation phase. So let's wrap this up. When you put everything together, the bull case for PayPal is actually pretty simple. This isn't a broken company. It's not a company that's running out of money. And it's not a company that people stopped using. PayPal is still deeply embedded in digital payments. It still processes massive volumes. It still generates high revenue and strong cash flow. What changed isn't the business, it's expectations. For the last few years, PayPal hasn't been exciting. Growth slowed, competition increased, and investors moved on to newer stories. And that's exactly why the stock has gone nowhere. PayPal's price has been stuck in roughly the same range for about 3 years. During that time, the business kept operating, kept earning money, and kept generating cash. That's important because long periods of sideways price action often build strong support, especially when the company underneath is still profitable. So the way I think about PayPal right now is this. If you have capital sitting on the sidelines, you always have a choice. You can leave it in a bank account earning a low interest rate, slowly losing value to inflation. Or you can put it into a real business, one that generates billions in revenue, produces positive cash flow, and has multiple ways to improve over time. PayPal isn't a get-rich-quick stock. It's not about hype. It's about owning a mature, profitable platform at a price where expectations are already low. And when expectations are low, companies don't need to be perfect. They just need to be stable and slightly better than feared. That's why this looks like a reasonable place to start scaling in, not all at once, but gradually. You're not buying PayPal because it will dominate everything again. You're buying it because it's still relevant, still trusted, and still positioned at the center of digital payments. And if the business continues to execute, the stock doesn't need explosive growth to deliver solid long-term returns. Sometimes the best opportunities aren't the loudest ones. They're the ones everyone stopped paying attention to, while the business quietly kept working. That's how I see PayPal right now. Just a quick disclaimer before we finish. Nothing in this video is financial advice. I'm sharing my personal views and research for educational purposes only. Investing always involves risk, and stock prices can go down as well as up. Always do your own research and consider your own situation before making any investment decisions.